Welcome to the Thomson Reuters Idea of the Week and Alpha Now. I'm John Cozy. While Europe's been the hottest topic lately, only the bravest of investors may be putting money there. For the rest of us, well, there's always emerging markets, right? Maybe not just yet. Last month, my Alpha Now colleague Sri Raman published a warning about emerging Asia. This beaten-down, export-driven region does offer low valuations, but we found a huge red flag. Today, we're going to talk about China. It's the 800-pound gorilla in emerging Asia with half its market cap. We'll revisit that after we highlight some key economic data for a country trying to transform itself from being export-driven to consumer-driven, all amid a weakening global economy. Slowing demand is helping push input material prices lower, shown here by the Thomson Reuters CRB index, down 20% from its April 2011 high. Some experts feel the 10-year upward price cycle ended then. Other key commodities continue to disappoint, including crude oil down 24% and copper down 17% from their recent highs. Here's China's overall producer prices index, shown on a year-over-year percentage change basis, as seen using Datastream professional portfolio analytics. Price increases have turned into decreases since late 2011 as growth slows. And imported goods, on a year-over-year percentage change basis, signal bad news for those countries that export to China. Now, here's the other side of the coin, China's total exports by year-over-year percentage change. Certainly not yet negative, but watch out. Europe and the US account for 20% each of China's exports. If European economies continue to slow, they can and will soften the US economy and could send Chinese exports to both regions into a tailspin. Now let's see what's been happening with the data from our May Emerging Markets article. May was a rough month for virtually every market, with emerging Asia down 8% from a year ago. China's down over 10%, and investors may think about this forward 12-month price earnings chart of Shanghai A shares as a reason to buy at under 10 times. Sure, it's cheap, but our earlier article showed that predicted earnings surprises in the next 12 months are still negative for emerging Asia at minus 1.6%. That's the lowest of any region, including developed Europe. By the way, a predicted surprise is the percent difference between Starmine's smart estimate and the mean estimate. China's got the second worst predicted surprise percentage in the region. Look down China's column and you can see at the bottom telecom, materials, information technology, and industrials as sectors that Starmine measures show worse than expected results in the coming 12 months. Smart estimates prove correct over 70% of the time on company estimates where the divergence is more than 2% either way. And a quick glance at the rest of the emerging Asian countries shows a pretty tough next 12 months for predicted surprises. So until we see better news in the form of economic data, expected positive earnings surprises, or something else, the evidence suggests avoiding Chinese stocks. And keep an eye out in the future as we look at other emerging markets for some cheerier data than we're seeing from China. For the Thomson Reuters Idea of the Week and Alpha Now, I'm John Cozy.